Thank you for joining us for another episode of the Financial Commute. I'm Chris Galeski, your host, and I'm really excited to have Todd Williams, Chief Investment Officer of Grubb Properties. Grubb focuses on investing in multifamily real estate. They've been doing it for close to 60 years, have well over 50 properties and about $2 billion worth of assets. Todd, thank you for joining us.
Thank you for having us, and thank you for all the support for our fund programs.
Yeah.
And certainly, I know we'll get into it a little bit, but we really do appreciate all the investment support that we've had with the Morton team.
You're welcome. We love investing in general, but it's not just investing in stocks and bonds. It's also in tangible assets like real estate. And you guys have a really cool story. Tell us a little bit more about Grubb and how you guys kind of attack the multifamily real estate market.
No, happy to do that. So Grubb Properties is getting ready to go on a 60-year-old firm. We were a firm that was founded in housing. In fact, Bob Grubb, the founder of our firm, the parent of our current CEO, Clay Grubb, now deceased, unfortunately, but Bob founded the company in actually single-family housing. Interestingly enough, in providing housing to folks that were otherwise locked out of it. Back then, banks practiced a form of discriminatory lending called redlining, and he didn't feel like that was right, but he also saw it as a business opportunity, and that's where we've always kind of seen mission overlapping with investment strategy. And in this case, what he did was basically provide nonprofit financing or not-for-profit financing for folks that were otherwise locked out of home ownership. And then that allowed him to fuel essentially a home building business at the time.
Wow.
And now since that time, we have really evolved into a multifamily manager, and then ultimately a multifamily developer today with our Link Apartments brand, which we can talk about in just a little bit.
There's a lot of different ways to kind of attack the multifamily space, and it's a popular form of investing. It's one of the asset classes that's done extremely well the last 20 years. There's obviously a need for housing because the undersupply across the country. Tell us a little bit more about how you guys invest in multifamily. What makes you guys different?
Sure. So, we have invested in multifamily now since the 1970s. We've done that in all sorts of different execution strategies, from value add, acquisition investing to ground up multifamily development. Over the last decade or so, we have been working on a particular product that focuses on a segment of the multifamily industry. And this particular segment that we focus on is really the moderate priced young renter. So this is the millennial or Gen Z renter, if you will, that is really driving this very, very significant demand for multifamily housing. Yet they have very different needs than their workforce housing counterpart, which is the folks that are typically using 2, 3, 4, and 5 bedroom unit configurations because they have families. That's working class families. This is the moderate renter that just doesn't have families yet, either because they're too early in their lives and haven't had family formation yet, or because they've chosen to postpone that, as many of the millennial generation has chosen to do for their careers and so forth. And
I didn't have my first kid till I was 40. So
I'm the same, and unfortunately, I'm not even a millennial. I'm a Gen X. So, but the interesting thing about that is it really means that they have a very different need in terms of the real estate. And what we've done is try to focus on what that need is. And one of the key aspects of that need is, one, they just don't have the bedroom configurations because they don't have those families. So that's an issue. 2, they really want to be and need to be in urban locations near jobs, near major amenities that they can avail themselves to, near transit. They need ideally to be near stable and growing job bases. And so for us, those are major medical, biotech campuses, research centers, universities, where there's a lot of growth going on in the economy. But the other key aspect of it is they also need to be in those types of locations at a price point that puts them in a range of income qualification between, say, 60% and 140% of AMI.
Okay.
And so that's a really, really difficult income segment to reach because of the cost to produce housing and the rising cost of producing housing that we've seen really over the last decade, more markedly so even over the last 2 years as inflation has been pretty rampant in the housing industry.
So your goal is to really build great units for the growing millennials, Gen Zers that don't need as much space, and you're able to efficiently build these units and maybe fit more into a building than what a traditional manager might do, and that could increase income that way?
Yeah, so what's interesting is, I'm a recovering architect and urban planner, admittedly, and what I've been amazed at is as I go around the country and tour apartment communities, I'm really blown away at how non-innovative the industry has really been over the last, I guess, 70 years since it's really been in place post World War II. And what I've really discovered is that the industry itself has not really focused on efficiency and not on any kind of programmatic way. There's certainly you can find multifamily developers that are doing individual projects with some of these characteristics, but nobody's doing it on a programmatic basis. And so we really tackle it two different ways. The first is through no coincidence because of my background, design. And on the design side, we build just 6 highly efficient unit floor plans, and we duplicate those across our portfolio. They're almost like a Lego block system, if you will. And so we rearrange them on different sites, create new skins that wrap those, and then that allows us to have really the most efficient product compared to our peers in the industry, literally right across the street from us, from a design perspective. Yet these units feel every bit just like any Class A apartment unit that's out there, with European style cabinets in the kitchen and undermount sinks and stainless steel fixtures, solid surface countertops, undermount sinks, all that. Glass backsplashes, under cabinet lighting, everything you'd expect in a kitchen. We really focus on squeezing out the inefficiency in the space, areas such as awkward corners or entry hallways, things that aren't necessities, where we can drive out space and focus on a space that's really important for the resident. So for us, 60-65% of our resident base are female residents, because they represent 60% of college graduates today, for example. Yet they suffer from a gender pay gap still. And so rent is even more sensitive for them. But amenity is important. And so for that resident, we even our smallest units have full walk-in closets, for example. So that's an idea where we're actually expanding space in that area, but cutting it out of other places, because that's what's really important for that resident. Or in our bathrooms, for example, we're doing 48-inch long vanity countertops with offset sinks, so there's plenty of countertop space and a full bank of drawers underneath. For product. I don't use a lot of that these days.
you and I don't have to use very much.
But our residents do, and so. So that's the way we approach design. It's from the inside out. How do we make the units more amenitized in suite for the resident, and how do we create a very, very efficient unit floor plan type that we can duplicate? Now, how does that compare in the industry? If you walk into an average apartment community in the United States today, it'll have anywhere from 25 to 30 different unit floor plan types compared to our 6. And I can tell you, there's just no way you can be that efficient with that many unit floor plan types. I walked a project in Aurora, Colorado, where we're building a project right next to the Fitzsimmons Innovation Campus, big medical, multi-hospital medical campus and biotech center emerging in just outside of Denver. And the project that I walked on was a little over 400 unit deal, and it had 100 different unit floor plans. Wow. And I was walking with a leasing agent and asked her, how in the world do you know what unit we're going to see here? And she said, I don't. I'll let you know when we get there.
So you can build faster then, because you're being more efficient with less number of units too.
Well, it's funny. It's actually helping us 3 different ways. One, we can design to permit quicker, which is accelerating our ability to to get shovels in the ground. Two, we can build it quicker. Not only can we build quicker, but also we're finding we're getting logistics benefits.
Yeah.
For example, our tub manufacturer delivers only one tub for every unit we have, and that's also very different than the industry.
Yeah.
Most apartment communities will have different tubs and showers for the different unit configurations. Right. So that logistics efficiency, for example, is providing a lot of benefits to us, especially over the last year and a half when we've had a lot of logistics issues in the industry. And then the third benefit is one that we're realizing now that we're at scale with this product. And our product, by the way, is called Link Apartments. Mm-hmm. We now have roughly about 12,000 units of this product, either fully built, under construction, or in various stages of pre-development in design and so forth. And so now that we're getting to scale, the third big benefit is that our management teams that are managing these properties are managing those same 6-unit floor plans. Yeah. And so they know how to lease those effectively. They know how to manage those for performance. Mm-hmm. And that's starting to pay dividends at a portfolio scale for us, which is really powerful.
Yeah, that's a nice tangible benefit in terms of you can have operational efficiency with that as well.
Yep.
There's obviously a lot of risks and benefits to investing in real estate. COVID was a big surprise for everybody. I love the story in terms of how you guys reacted during COVID, not only to help protect yourselves, but also your tenants. Why don't you share with us some of those things those changes that you guys made when COVID came about?
So it's interesting, at the outset, of course, nobody had any idea what the true impact was going to be. And there were all sorts of stories, both anecdotal and real, about whether rents would even come in at any meaningful range that would allow us to do everything you need to do as an owner, from paying operations teams and vendors to making debt service payments. Sure. And so that was a real scare at that time in early March, and I recall it very well. But fortunately, we had a very, very progressive and thoughtful CEO who said, we got to get out in front of this very, very quick. And we got together as a team and we said, look, how can we motivate our residents to get their rent in early so that we'll have confidence going forward that we can continue to perform at the highest level. Yeah. And we did that. What we did is we went out to our residents in March and we provided them a discount if they prepaid their April rent.
No kidding.
And we had a very, very high collection basis on that, which gave us then the confidence to move forward. So what we did is then we went to our vendors and we said, look, if you get your bills in by the 25th of the month, we'll make sure you're paid right away. Yeah. And but we need you to do the very best service on our properties. And so we did that. Our vendors were happy. They gave us that best service. And if you remember at the time, that service meant a lot of extra cleaning and sanitizing, because those were perceived issues at that time. Yeah. And so that made a huge difference. And then our residents, I think, had a 10% discount if they prepaid their rent. We then continued that program for the very next month. Mm-hmm. And I think one of the things that did for us is not only give those residents that benefit then, and this was before PPP and all of the additional programs that came out, but it then built an entire loyalty program almost with our residents at that point. And we had just rolled out that year as well a renter loyalty program, which I think we may be one of the only national companies in the country that even has such a program, where if you lease from us long term, we'll provide you a cap on your rental increases. And so nice. That's also another powerful way in which we can seek a win-win with residents and with our operations. Yeah. And it's actually really beneficial. It's truly a win-win, because not only do the residents get the benefit of that cap, but we have lower turnover costs, which is a huge cost in the industry, because you have downtime when the unit has to be remarketed. You have refurbishment costs that you
Paint,
have to
flooring,
put in, paint,
yeah.
floor, all that sort of thing. And so if you can reduce that, it actually is more beneficial to provide that
Right.
as a cap for that resident than to incur those costs. And so we always, that's a case in which it's been beneficial to both parties.
That's pretty cool. Obviously, a lot has changed since COVID. With all the money printing and stimulus policies, we've now been seeing the fears of inflation the past, call it 9-10 months, and we've seen the rise in interest rates. As you guys look at making investment and property decisions out in the future, how are you guys navigating this new landscape? Are you changing your strategy at all?
Yeah, so it was interesting. At the outset of the pandemic, not only were we being aggressive on the defensive side by putting in place a lot of those things that we just talked about and many more, but also we decided we were also going to play offense. And so on the offense side, we saw a huge opportunity taking shape, especially in the gateway markets, where we had this temporary flight of consumers, residents, out of those markets, and also a flight of capital out of those markets, very significantly. So rents were decreasing, occupancy was decreasing, and capital was flowing. And capital was flowing into more of the growth markets in the South, Southeast, Southwest. And so what we decided to do was try to take advantage of that temporary dislocation. We had no idea, because we felt long term those markets would be solid. They had been for as many recessionary periods as we could look back at. They had typically low correlation to recessionary risk. Obviously, the pandemic was a different type of risk, but we felt that they would recover. We had no idea they would recover quite as quickly as they had.
Right.
But what that did is it opened up the opportunity to secure sites for new development at incredible discounts. So we went into markets like LA, the Bay Area, New York, DC, and even to a lesser extent, the Denver market, which is a bit of both a resilient and growth market. And we were able to secure very, very significant discounts. In many cases, we were able to secure subsidies, and that gave us a lot of confidence to go in those markets because we felt like we had this nice margin of safety that we were building with pretty significant lower cost basis than had typically been there pre-pandemic. Right. In markets that are normally super high barrier to entry and have enormous housing challenges, right. Even more so, even more acute than many of the traditional high growth markets.
Yeah. Well, Todd, thank you for sharing your story. We really appreciate the work that you guys do in helping us protect our clients' capital, helping them find ways to grow and generate income. And I just think your story is fantastic. So thanks for joining us today.
Well, no, thank you for having us, and thank you for investing with us. We really appreciate all the support. The program that we've been working on is, as it's gotten to scale, it's really become even more powerful, and we're just so happy that we could team together.
Yeah, perfect. Thank you.
Thank you.